Hey traders, Raghee here, and in this free video, this recap video, I'm going to talk about the aftermath of Facebook and anticipating Amazon and what that means to NASDAQ and S&P traders. And we've talked about it quite a bit in the chat room, and we've talked about it quite a bit in the premium videos and also the free videos. Is during this time of year, during the earnings season, you've got to be able to understand the weighting of certain stocks in your index futures. And you can see the kind of names that I have listed here. I use this service called Estimize. It's free. It's actually run by a buddy of mine that I met many, many years ago. It is my favorite free source for understanding and playing earnings. And why would a futures trader play earnings? Because the weighting of certain names within certain index futures, in this case the NASDAQ, think about the impact the NASDAQ has or on the NASDAQ from Facebook, the impact from Amazon. And these are the kind of things that we need to be acutely aware of, because especially when they come before and after the bell, we're going to have an impact on the futures contract, and that would be a risk event. You might decide to get out of the market before that. Like a lot of people saw what the Facebook miss did to the NASDAQ. It was a monstrous move to the downside, right? I mean, you can see it back in here. So let's go back to yesterday. That was the Facebook effect, right? Take a look at the Amazon effect today. So first of all, these earnings are going to have an impact on the timing and therefore also the risk on your trades. So how did we take advantage of the Facebook effect today? That meant that on the open, I was going to assume there would be some volatility after the Wall Street bell rang. And that volatility sets up some ranges that we can take advantage of. And that was really a big part of what I wanted to do during the open. So we actually follow a process where we project lows. We project lows, meaning that if the market hits certain levels, we would deem those at certain times of day. So every hour of the day has a typical price movement range. That's something we've talked about quite a bit. We call those PMRs, daily PMRs and hourly PMRs. We also have another thing called an expected PMR, an EPMR, which projects new levels every 15 minutes. So we use these levels to determine where the market could go and if there is an opportunity to buy there. And we waited a good 15, 20 minutes for the NASDAQ to hit two levels. And these are the calculations that we did. Here they are. So we were looking for these levels, 74.06 and 73.96 and 73.88. And we basically put limit orders to buy down at those levels. And we basically sold off on the NASDAQ into that zone, right? That's what we want to take advantage of, the market going down into that zone. So we hit 74.06, and we also hit that second level here, the 73.96 with that 73.95 and a half low. So those limit orders are tagged, are filled on that sell-off. Now, a lot of traders, if they didn't have these projected lows, wouldn't know that that candle, this right here, is an opportunity. They wouldn't know. So by understanding what seems to be sort of an invisible exhaustion, and we use a couple other tools here, but by using these levels that seem to be this invisible exhaustion, we're able to capitalize on that. And there's a number of ways we do it. We can do it via the actual calculation. We can do it via a study like this, which is the hourly price movement range cloud, something that we're utilizing in the room. You can see where the entry entered the cloud right down in here. Now, these are indicators that we use in the room that utilize the hourly price movement ranges across multiple futures index charts, as well as stocks, as well as futures and many commodities, stocks, ETFs. We use this information. So what do we do with that? We buy, right? We look to enter long, which is exactly what we did. And then we look to exit once the market moves a set amount of points. Typically, we want to get out before the market has to break to a new high. Meaning, and this is a really good tip, don't make the market have to make a brand new high just because you're long. Make sure you're being observant as to where the market's exhausted before and get out before then. And you can see how much time, how much the market struggled with this area that established resistance early on in the day. Okay? So we pay ourselves while we can, not when we have to. We did something very similar on the Russell, but what I want to emphasize here is the power of these kind of invisible, they're not really invisible, but what they do if you don't know how to calculate these projected lows. And that's exactly what we did. 2 out of 3 of our projected lows triggered an entry, got us long, and it was a very nice pre-11:30 cutoff trade. So I hope this helps you with some of the framework of how you're trading the morning. When the market sells off, do you have a way of calculating what that sell-off amount could be and where ultimately that would land and what you would do once you get there? And that's exactly what we did today with the NAS. Hope that helps, and I'll see you in the next update.